Let's bring in Jack Malvey, BNY Mellon. I'm so happy to have you here. I'm going to ask you a question that you don't want me to talk about, but I've got to. All weekend, it's going to be another Lehman. You, for years, the esteemed decades or more. How many years were you at Lehman?
Almost 17, Tom.
17 years. This is going to be like Lehman. You got to be kidding me. I mean, this is not equivalent to what Lehman Brothers went through.
Well, that's for sure, both personally and for the markets. As we recall, we set off a financial panic that lasted 6 months, and we see nothing in the cards like that.
What do you see in the cards if we get through this, we get it signed, 2-point-some trillion, nowhere near 4 trillion?
Well, I think we see a continuation of the kind of turbulence range-bound over the course of the last several months. I think it's not just the U.S., it's also Europe, and I think already the market's turning its focus away from this deal to the global economic deceleration.
Global economic deceleration. We saw spreads widen out in Europe. Why did they widen out today? Is it because of Washington, or is it separate to Europe?
Tom, I think it's separate. I think it's really European specific. I think there's still questions about the adequacy of the deal and whether we've really ring-fenced both Spain and Italy. So those questions hopefully will be soon resolved.
Proving once again I don't have a job. I get to talk to Jack Malvey and Peter Fisher all in one day. Earlier this morning on Bloomberg Surveillance, I spoke to Mr. Fisher of BlackRock, and I asked him how we can have austerity but also stimulus at the same time if we look for, QE3 or 4 or 5.
There's a lot our government can do to reduce its spending profile over the next 20 years, and it really might be penny wise, pound foolish for us to cut too much over the next couple of years, especially when you see how weak GDP was.
Have you calculated in what this will do to reduce GDP?
Not exactly, Tom. There is a sort of a general supposition, I'm using consensus views, that the fiscal drag in 2012, for example, might be about 1.2 to 1.5%. So in other words, just to grow zero for next year, the economy needs to grow, let's say, about 1.5%.
Where it is right now.
Exactly. So we're really looking at a slow growth, long time scenario, unfortunately for the U.S. and probably Europe as well.
Where should our viewers hide?
Well, they can hide in cash, certainly. That's always reliable over the short run. And the viewers many have been expressing their interest in commodities, particularly precious metals. But I think the long term, you really should look at a balanced portfolio approach, equities, fixed income, conservative, and I think that's really the hiding place.
It's is it the end of an era? I let off radio today, the script saying it's an end of an era. Arthur Levitt said, well, we won't know for 10 or 20 years. Was it an end of the, I'll get this out, it's Monday, excuse me, it's English Free Monday. Was it an end of an era this weekend?
I think it's been an end of an era since roughly 2009, 2007. There have been at least 3 eras since post-World War II. I think we're beginning the 21st century era, and it's going to take 5 to 10 years really to put in place. So a long time to fix. Chart
here, it's a Jack Malvey chart. Actually, Michael Powell was the one that gave me the idea at Barclays, but we'll give it to Jack Malvey today. Debt angst out the curve, 530s. We go out, and the reaction, Jack, where are we right now on that? 277 beeps. The difference in yield between the 30-year bond and the 5-year piece. What does it signal to see us so uniquely steep right now?
It's, as you highlight, a manifestation of risk aversion in the marketplace here. Investors are so uncertain about so many parameters and so many economic outcomes that they're preferring the short and medium end of the curve, giving a diminution in demand to the long end and resulting in a steepening. Although on an absolute basis, the long end of the curve has come down over the course of the last several weeks here. So we did have a pretty good rally in the month of July at the long end of the curve, but steep curves are going to persist.
Well, Michael Schumacher at UBS suggesting literally a jump condition if they screwed this thing up. Did they, or could we spring up 25 basis points or so with a downgrade right here, a rating downgrade?
I really think the downgrade threat is really overdone. We've already had a downgrade from Egan-Jones. If we get another downgrade from one of the major agencies like Standard & Poor's, I think arguably that's been well anticipated in the market. I think we'd have a trivial effect. So it's really less the downgrade. It is to the degree that if for whatever reason Congress doesn't go along, that certainly could create a big jump in the curve here, a big steepening. But that's certainly not our prediction.
Yeah, here's the number of the day. Julian Callow writing this up in the early London morning. It's the number, rather. 25 basis points, that's hundredths of a percent. Jack Mellvey's kids know how to move the decimal around. 25 beeps, possible potential increase in borrowing costs with rating downgrade. So that's one calculation of AAA to AA plus. You say it's not going to happen.
No, I don't think that's really realistic. I mean, already, for example, the market anticipates a downgrade, and it's been rallying today. So there really is, I don't think, any major calculation that can demonstrably say that it'd be 25 or 30 or 40. There's been a lot of conjectures out in the market. And indeed, if you look at some of the previous downgrades of AAA to high AA, the effects a week or 2 weeks later have only been 1 or 2 basis points. So I think that would be the realistic magnitude.
Okay. Here's a note I want you to comment on. Simon Johnson, Bloomberg View, folks. David Shipley, James Ruman, what a great job they're doing there, really moving the debate forward. Any true fiscal conservative should fight to strengthen the legislative and regulatory safeguards that aim to make the financial system less prone to collapse. This is about banks having more capital being the way that we instill a new confidence in the system. Do you agree with that? That they need to have more capital?
I think in general, certainly that is wise, and that's been something which policymakers have been very keen to implement over the course of the last several years, and that is one of the parts of the new financial era. And it's not just banks. The new financial conservatism, arguably, is descending across the global capital markets, and that's something which hopefully will diminish the threat of the events of the last 4 to 5 years.
Thanks for coming in today.